Can you show the chart that shows consumer debt isn't higher than it has been? So the chart that you're referring to isn't that consumer debt is not higher than it has been. The chart you're referring to is the chart we looked at yesterday, which is the ability for consumers to pay that. So what you would do is you would look at household spending as a proposal or on debt service payments as a percentage of disposable income. That would be what you're looking for. So yeah, I'd be happy to pull that up because I think that's an easy one to forget. So that chart would be right here. This chart shows you household debt service payments as a percentage of disposable income. And so you could see that percentage is really just on trend with what we've seen over this last decade. So we know that a lot of folks are under this impression that, oh, well, consumer debt is skyrocketing. This is true. Consumer debt is at a higher level, but our capacity to pay for that is not at a higher is not suffering from these higher debt levels, which I think is really interesting. By the way, if you like the way that I'm able to stream and I kind of throw up these mobile banners or throw up articles or reports or whatever, all of this right now is not being done with any kind of stream capture technology that's physical. It's all being done with software. It's all being done with StreamYard. So consider this paid promotion. Check out metkevin.com/StreamYard to learn more about that software. Help out the channel by going to metkevin.com/StreamYard and continue to support these free broadcasts. So thank you for that. I want to be clear. StreamYard is a paid promotion, but they're a phenomenal product that I absolutely love. Okay, great. So let's look at some other things here. Do you see opportunities to buy in longs? Yeah. So I just find it very difficult to be bearish at the moment because again, the more bear reports I look at, the more I'm unimpressed by bear reports. I do want to be transparent that I am concerned by some things, such as the inverted yield curve and the depth of the inverted yield curve. However, when it comes to actual data, I'm not seeing it as heavily. Promotion, that's right. How do you like Eastern? I actually don't mind Eastern because you can wake up at like a normal human being time. So I actually really enjoy Eastern. New car payment delinquency or repos. I'm sure we could get something like that. The car market is doing poorly. If you're looking for signs of recession, cars are probably the place to look. Credit tightening is happening the most in cars, in my opinion, especially subprime auto. Auto delinquencies for subprime I would expect would be very high. I think it's very difficult to sell vehicles right now, with the exception of some, maybe EVs, but in terms of regular cars, it's a difficult market. So I'd be interested. We could probably get some auto data here. Let's see if I get some auto loan data. But yeah, autos are getting hit hard. So consumer loans, LTVs. Let's see what we can. Oh yeah. Well, here's an example for you. This is actually consistent with what I suspected. But look at this particular chart here. That's not the chart that I wanted to show because that's the same one I had. Hold on. Let me get used to what I'm doing here. There we go. I pressed the wrong button. It was a user error. There we go. Net percentage of domestic banks tightening standards for auto loans. As you can see, it's the auto loan sector that is seeing the substantial, and this is based on Q2 2023, a substantial increase in the tightening for auto loan standards, almost consistent with the levels that we saw in the pandemic, with 55% of banks tightening standards for auto loans. Right now, only about 27.5%. However, well above what we had seen in the decade prior. So you clearly see an expansion of tightening for, auto standards. And I think I see this at least. If you look at the auto Twitter space, you consistently see this fear over, oh my gosh, autos are clearly in a recession because banks are continuously cutting dealers off of lending. It's getting harder to find lending for autos. The subprime auto sector is getting hit. Delinquencies up, repossessions you would expect are up. None of this is a terrible surprise, though, and it would be consistent with the credit tightening that we're seeing, really driven by the Federal Reserve. So, and subprime is going to be the segment that first gets hit, always. It always makes sense that subprime gets whacked first, and that's what we're seeing. So, yeah, I'd like to get some more data on delinquencies, though. Let's see, yeah, delinquency rates, at least on the St. Louis, the Fred website, they're a little more difficult to grab. And then if we look at auto loan delinquency rates, 90 days or more for all auto loans, rather than just the delinquency rate for subprime, you're not seeing a substantial explosion. I mean, you could look on screen now. You could look at Y charts here. We're at a 3.89% Q1 2023 90-day or more auto loan delinquency rate. That is substantially lower than what we saw obviously during COVID. In 2018 Q2, we were even higher at 4.17. 2019, we were 4.6. Now, it's possible that because this is 90 days late, there's going to be a lag in this data, but we shall see. Again, I really think you're seeing more repossessions and more issues in subprime than in the broad auto market. This chart here being specifically referring to the entire autos market rather than just the subprime sector. Now, if you do look at subprime specifically, there is an Axios piece out, and Axios makes it very clear that low income households are falling behind on car bills. And this is really what you have to differentiate with is that there's subprime auto and then there's prime auto. So a subprime auto score is usually considered to be under 620. So if your credit score is under 620, my friends, you are probably in a recession because you're looking around going, food's more expensive, everything's more expensive, rent's more expensive, cars are more expensive. I can't get a loan for a new car, getting screwed left and right. If you have a low credit score under 620 or you are a low income household, you probably feel this recession more so than anyone else. Now, there is the argument to be had that the wealthier individuals, that would be like your white collar individuals, are also feeling the recession quite hard or this recessionary time, specifically because of this fall in asset values that we've seen. But most of that pain was felt in the second half of 2022, not so much now anymore since we've seen so much of a recovery. So I find this consistent with what you would expect in a recession. That yes, or a recession or this sort of tightening process, whatever we call this, recession of last year or tightening process, whatever you want to call it. I would find this pain in lower income households falling behind on car payments and subprime auto delinquency rates exceeding what we've previously seen. I would find this consistent with the environment that we're in right now. As you can see, it's actually not that much higher than what we saw between 2017 to 2018 or during the recession of 2008, which is kind of remarkable. You would think that this line would be higher. This is probably going to go up even more. So stay tuned. I would probably see this go up even more. So some comments here about Carvana being a joke. I think that goes without saying. But yes, thank you for reiterating that. Uh, Consumers with low credit scores are falling behind on their auto loans at a record rate. And this does lead some people to be able to create this sort of clickbait of, oh my gosh, recession. Just look at the auto sector, it's imploding. I don't find a consistent argument to suggest that the entire auto sector is imploding. I do think that the auto sector is seeing price decreases. I think it's seeing a normalization of inventory, and the lower end is certainly getting hit harder. That is clear, without a doubt. Uh, but I don't see this at crisis levels. We'll see. But anyway, the share of payments on so-called subprime auto loans that were at least 60 days late rose to more than 6% in December. Subprime loans have high interest rates that are typically made to people with low credit scores. Delinquent payments are the first step towards default and the car being possessed. The December delinquency rate is a record, eking past prior peaks just before the pandemic, according to S&P Global. The uptick reflects the steady weakening of the finances of poorer American households. For one, the cost of living has surged. Now, not only has the cost of living surged, but now you're seeing, again, it's becoming more difficult to actually finance these vehicles, as well as more expensive rents and more expensive food prices is a problem for poor individuals. In fact, there is an argument to be made that we might see the return to some form of stimulus, stimulating of the economy, stimulus of poor individuals specifically, because of the disproportionate burden they might share in this correction that we're going through, whatever it might be called. So you could end up seeing, in my opinion, if we ever did return to stimulus checks again, I think you would see something that was very tailored to your lower end. I would say that would be individuals making less than $40,000 a year. That's also very consistent with what we saw during the pandemic with Mitch McConnell programs, right? Mitch McConnell programs consistently uh, aligned with, hey, let's give people who need the money the most the money. So give people making $40,000 or less stimulus checks or more unemployment benefits, but don't preserve that for households making up to $200,000 or in California where they're handing out stimulus checks to households making over $500,000. That's just insane, right? That I would not expect to see any kind of return to that sort of level of stimulus, not anytime soon. So, furthermore, let's look a little bit more at this Axios piece because I actually think it's pretty decent. Subprime sectors of both mortgage and auto finance tend to have higher incidences of practices perceived to be predatory as well. Yeah, this is also true because you're getting, there was a piece in the Wall Street Journal a couple months ago, and I could be wrong in my memory or recollection of it, but I believe it stated that 70% of subprime autos, loans that are made, could default, and subprime lenders would still be profitable. They would still be profitable because subprime lenders charge so many points up front to even make your loan that they make most of their money up front. And the fact that you default is almost this foregone confusion, or a conclusion rather, which is quite remarkable. It's unfortunate, but again, a lot of this is just consistent with what you would expect with higher interest rates. So again, we'll pay attention to it, but I don't know that I would consider this a red flag for the broadest parts of the economy.